All right, CFA Level 2 people, listen up. We're going to dive right in and crack open one of the toughest parts of the curriculum, credit analysis models. My goal here is to give you a visual, almost infographic-style guide to reading 35, so this stuff really sticks when you're sitting in that exam.
So here's our game plan for today. First, we're going to get our hands dirty with the calculations, how to actually value a bond that could default. Then we'll pull back and look at the bigger picture, decoding what spread curves are telling us. And to wrap it all up, we'll build a one-page revision dashboard that's going to be your best friend during final review.
Okay, first things first, we're jumping straight into the nitty-gritty. This is the core quantitative skill you need from this reading. Putting a fair price on a bond when you know there's a chance it might not pay you back. Let's get to it. This right here is our mission for this section. You've absolutely got to have this calculation down cold. It's a classic exam question.
So how do we actually assign a dollar value to that risk? Well, we use this thing called the credit valuation adjustment, or CVA. You can think of it as the market's discount for taking on default risk. It's the exact amount of money we're going to subtract from a perfect, risk-free bond's value to get to the fair price of our risky bond.
And you know, the good news is, this isn't some kind of crazy, complex process. It's actually a really logical three-step dance. Step 1. Pretend the bond is perfect and value it as if it's risk-free. Step 2. Figure out the cost of the risk. That's our CVA. And then Step 3, the easiest part. Just subtract that risk cost from the risk-free value. Boom. That's your fair value.
This right here, this is the engine room. This is what makes the CVA calculation work. For any single time period, the expected loss is just three things multiplied together. How much you stand to lose, what percentage of that you won't get back, and what's the chance of it all going wrong? Getting how these three pieces fit together is literally the key to any CVA problem they throw at you.
Okay, now let's talk about the exam traps. This is where people drop easy points, so pay close attention. When you're doing this valuation, you have to live in a risk-neutral world. That means you must, and I mean must, discount those expected losses using the risk-free rate. And you've got to use the risk-neutral probabilities they give you. The examiners will absolutely try to trick you by throwing in other numbers. Don't take the bait.
All right, so we've nailed down how to value a single bond. Now, let's zoom out. We're moving from a specific calculation to reading the tea leaves, interpreting what the market as a whole is telling us about a company's risk over time. So our mission here is basically to become fluent in the language of credit markets. By the time we're done with this section, you'll be able to glance at a credit spread curve and immediately understand the story it's telling about a company's health.
You know, these curves really only tell one of two stories. The first story is pretty normal. It's an upward sloping curve. That's what you see for healthy companies. It just means the further out you go, the more uncertainty there is, so you want a bigger spread. But that second story, whoa, that is a massive, flashing red flag. An inverted, downward sloping curve means the market is screaming that the risk right now is so huge that the long term almost doesn't even matter.
And what makes these curves take these shapes? Well, it's not random. It's a mix of big-picture economic stuff and things specific to the company. Like in a booming economy, you'll probably see steeper curves. Or if a company does a big leverage buyout, that could steepen its curve. But on the flip side, what causes an inversion? Think about a company with a severe short-term cash flow problem. That's the exact kind of thing that tells the market danger ahead.
Okay, quick pop quiz. You're looking at your screen, you're in the exam, whatever. You see a company with an inverted credit spread curve. What's the very first thought that should jump into your mind?
It's got to be this. The company is in trouble, and it's in trouble now. The market is signaling immediate danger. The risk of default in the very near future is seen as so high that, frankly, the market is questioning whether the company is even going to be around long enough for the long term to matter. And again, please watch out for these traps. It's so easy to mistakenly think an inverted curve means, oh, things must get better later. No, it means things are absolutely terrible right now. So you should totally expect a question that describes a company in crisis and asks you to predict its curve shape. The answer is going to be inverted.
All right, let's pull all of this together. Think of this last section as your master dashboard, your ultimate cheat sheet. It's everything we've talked about distilled down for a final high-impact review.
This is it. This is the whole thing on one page. You've got your core evaluation formula right at the top. You've got those key relationships that show you intuitively how value and spread move, and you've got that quick comparison of the curve shapes. Seriously, take a picture of this, memorize it. This page is pure gold for exam day. And just one final piece to put everything in context.
All these ideas we've talked about, they fit into two big families of credit models. You've got structural models, which try to explain why a default happens by looking at a company's books, and then you have reduced form models, which are more concerned with when it might happen using market data. So it's really the why versus the when.
And that pretty much wraps our deep dive on Reading 35. But here's the thing I want to leave you with. None of this is just for an exam. The shape of a credit curve is a powerful, real-time indicator that pros use every single day. So the real question isn't just can you pass the test, it's how will you use this to spot the next big risk or opportunity out there. Thanks for tuning in, and good luck.